This is the start of a big crisis.
Which is why I'm encouraging my Democrat colleagues.
Clarity Act markup could come out near Easter. Now, the White House and the Senate reportedly reached a preliminary agreement on digital asset regulation aimed at resolving the clash.
It will keep America as the most dominant player in the world economically.
The latest sign that the private credit world could be facing a reckoning. This is the front edge of a systemic credit issue the markets are going to have to deal with, all the way to the other end saying it's just a little bit of a liquidity mismatch.
I expect default rates in private credit could be north of 20% over the next few years. The minute you have market stress, there's huge problems.
For the last couple of years, the credit markets have been really pressured. You've had higher interest rates, high default rates, even while the overall equity markets were strong. Software, the threat from AI, the Iran war. My gosh, before it was all these sticks piling on the credit market. Now we got lumber.
Stocks are going to rebound. They're going to bounce back nicely. Don't worry. Are you sure of that?
I think stocks will come back, Stu. I think the question is how quickly, right? So we've talked a lot about oil being that key headwind, right? I do think you need the removal of that, right? But I think the picture is a little bit different than it was before the war started, right? Now you're talking about, is the Federal Reserve going to cut interest rates at all this year, right? That's become a market question. You were looking at the 10-year Treasury yield at the top of the hour here. That's close to 4.4% now. That's starting to get in an area where it's been a little bit of a market headwind. So I think you have earnings season coming up. You're going to want to hear from companies about the impacts of the oil shock, and then sort of where is our AI story. There's a lot more going on. I think we can still move higher throughout the rest of the year, but do we instantly just go back to trading near 7,000 on the S&P 500? I don't think you instantly get there now.
What's the difference between this year and last year? Because everyone was bullish. When this Iran conflict began, the narrative was this could be a lot worse than tariffs. And yet strategists have not gone down in their targets for the most part.
I think part of the reason first is the U.S. economy is a much stronger position today than it was last year. For example, our house views that growth is going to be 2.6% this year, which is an acceleration from last year. Now, inflation is somewhat sticky, but for nominal earnings, that is not a problem because it is still a lot more manageable. So I think the environment is certainly different right now. Right. We have tremendous amount of earnings momentum, which is one of the biggest reasons why we are so much more optimistic. The fundamentals of the U.S. economy and the earnings power U.S., especially U.S. tech, takes over quite substantially, and that's the reason why we're bullish.
Brokers Connection.